I think it's time for us to get started. Thank you for attending today's discussion of FedNow, the planned real-time payments network by the Federal Reserve. I'm Doug Holtz-Aiken, President of the American Action Forum. Astute readers of the agenda for this event would expect a keynote address by Congressman Ted Budd. His day job has delayed him, so we're going to juggle the schedule a little bit. We're going to start with the panel. When the Congressman arrives, we'll suspend. He'll talk to us for a little bit, and then we'll pick up the discussion after that. So my job now is to turn things over to John Heltman, who has graciously agreed to moderate the panel. John works for American Banker and has the beat of Treasury and Federal Reserve for about the past 5 years. Prior to that, he was with Argus Media and had the CFTC and derivatives beat there. So thank you very much, and welcome.
Thanks, Doug. And joining me is Mike Lee from the Bank Policy Institute, Carrie Whaley of the Independent Community Bankers of America, not the Independent Community Bankers Association, which
Correct.
is a typo we would frequently get at American Banker, and of course Tom Wade from AAF. So let's just start at the absolute beginning. What's faster payments about, Tom?
The absolute beginning. So in 500 BC, so cash. The advantage of cash is it is, of course, immediate or instantaneous. I will give Carey £10. It will have instantly left my pocket and will be in his. We've seen a few developments since then, mostly checks and electronic payments. And the flaw there is that the transfer itself is often not instantaneous. You think about your traditional 3-day for a check to clear. We do have a couple of modern options like PayPal, Venmo, and Zelle, which approach this idea of instantaneous banking. The way they do that is that if I gave Carey the £10 via Venmo, what's happened is Venmo has actually fronted the £10 directly to his account, and then it will come out of mine at a later date. The reason why that is not instantaneous payment is that for that to happen, there needs to be an IT infrastructure, a system, a payments network that makes those payments possible. This is obviously entirely possible, but it is a huge undertaking to build this network. And so in 2017, the Clearinghouse, a private organization, invested millions of dollars in creating this system. And then very recently this year, in August, the Federal Reserve announced that it too would be creating a real-time payments platform.
Gary, can you tell us a little bit more about, so this is the faster payments thing is about making these transactions happen faster. How do transactions happen now? Like, what is the current sort of payments apparatus?
That's a really good question, particularly back to back. What I liked about your illustration was you talked about giving me money. Usually the way we do payments right now, first, I like getting money. Let me be serious about that. But the way we make payments often, it's very similar. It's a different model. I give you a check, which has all my credential, all my routing number of the bank. It has the account number. I give it to you, and I trust that you're going to pull that money out of my account. Right there's a lot of security issues right off the bat. I mean, if you're identity theft, let's see, you have the name, you have the address, you have the routing number, you have the account number. That's pretty much a motherlode of personal information. So what we're trying to achieve with real-time payments through either operator is trying to get an area where every bank is involved and every bank can play, but that money is, instead of pulled from the account, it's pushed from Mike to me, not from me to Mike. So, that's or Tom, sorry.
Yeah, I was going to say, I'll take it.
I'll take it from both of you guys. So I think that's the opportunity of what we're trying to accomplish, is we were trying to build a different flow of payments so it protects the data.
But also an important point is that there are two networks, right? In the ACH, there's the Clearinghouse network, and then there's the Fed network, right?
So payments, really to me, a lot of times when we talk about payments, we put a cloud on the PowerPoint. To me, payments is a Swiss Army knife. It's got a number of rails and a number of blades that serve a number of different purposes, whether it's credit card, whether it's debit card, and then there's check clearing, ACH, and wire transfer. In those blades, check, ACH, and wire, you have a private sector and a public sector. And they've been competing against each other in the case of check ever since the Fed was established.
And Mike, Tom mentioned that the clearinghouse has developed a real-time payments network. Can you describe sort of the timeline of how that came about, how that decision was made to create it, and how it works?
Sure. I mean, the timeline is kind of very public, but it kind of got started because people view the U.S. as being behind, that there are other countries who have been able to move much faster towards real-time payments. There are other countries that do a much better, kind of more tech-focused way of moving money with mobile payments and other things like that. Part of that's the infrastructure. Part of that's the number of banks we have in the country, things like that. But as part of kind of moving that process forward, the Fed convened a group, the Faster Payments Task Force. That's part of a way of getting everyone in to be able to talk about, what a new system should look like, what should be the goals, how do you bring everyone together to do that in a way that doesn't create kind of antitrust problems and brings together everyone who's involved in that process. They set out goals, they set out metrics that they wanted to achieve, and then as part of that, the clearinghouse banks got together and put a proposal together, started building a system to meet the goals kind of laid out by the Federal Reserve and customers and others, right? It's one thing to have these goals that were set forward as kind of principles at the Fed, but really this is about driving a change that is due, is something that customers demand, and we need the infrastructure there to do it.
And how much reach does the RTP network currently have?
So I believe currently, I mean, the most recent stat I've heard is over 50% of the demand deposit accounts. So the reach is one thing, the use and the volume is another. So
there's different ways of kind of
measuring
metrics,
how
yeah.
much, right? And you could measure dollar volume and other things. And to Carrie's point, it's a Swiss Army knife in terms of payments. There are still competing ways of spending money. If you're comfortable sending money that gets batched, or you're comfortable using checks, and you don't feel the need to move towards a real-time payment, then you might not move your volume over there yet. The reach is growing. The reach got advanced this week with Jack Henry signing on or going live onto the RTP system. That brings the reach that it has to other community banks, smaller banks. The clearinghouse banks are all connected, but then it's about kind of driving products and volumes toward that system. So finding ways to serve customers in a real-time structure.
And so, Carrie, how do independent community banks feel about the RTP network? It sounds pretty good, right?
The first thing is that the clearinghouse and the Fed have been competing head-to-head on 3 different payments folks, and our banks don't. Historically, our banks haven't heard from the clearinghouse on payments systems. They don't know who their salesperson is. They don't know who to call if they wanted the service. So this is a new frontier for them. And even the way going through core processors, I don't think there's still a designated person in charge of the community bank market. So we're very much on the wait and see a lot to see how much the clearinghouse wants the market of 5,500 community banks, and then if you add credit unions, you get the number up to 11,000. That's a vibrant situation. The 50-60% you said as deposits accounts is accurate, but it's also represents 18 banks. Mm-hmm. So you got a long way to go. Mm-hmm. And our concern from our standpoint has always been we want every bank to have this blade, the opportunity to access this blade in the Swiss Army knife. And it's not that we want a monopoly from the Fed or want a monopoly from the clearinghouse. We want choice.
And that brings us to, I wouldn't say the present exactly, but August, when the Fed made its decision or made its announcement that it's going to start its own real-time payments network. I think the expectation is in the next 4 or 5 years is when they think that's going to be online. Mike, what does that mean for the RTP network? Like, what is the practical implications of that decision?
Yeah, that's a good question, because I think what Carrie's pointing to is there's a whole lot of banks out there, and building the system is one thing, again, and getting banks to sign up. There is a lot of individual outreach that has to go on. There are meetings where you have to go, again, introduce yourself, sell the product, and then the bank has to decide they want to do it, right? We can't just kind of go in and plug them in and get their volume. The decision for the Fed to enter, I think what TCH was seeing was when the Fed first announced that they might do it, that some of those conversations with smaller banks chilled a little bit because people wanted to wait and see what the Fed proposed, what the Fed went forward with, and what their timeline was. Now that the Fed has announced a timeline, but is also not yet announced a structure, they're taking comments on what it should look like, what features, things like that. I think that some of the anecdotal evidence is that there are some banks who have viewed the 4 to 5 year timeline as being too long, and that they've gone forward and either started the process of joining the RTP network or made a decision to, again, either wait or join. A lot of that will, again, be driven by customer demand for those types of payments. If you're a bank that has customers that are going to want that, if there's an insurance company or some type of entity that's going to be wanting to make sure that funds are verified when they're sent, and they're going to want to do that soon, and you're a bank who wants to keep that relationship, you might feel like you need to make that decision much sooner than later, because the customer can go to a bank across the street that might be providing it already.
Totally agree with that. One thing that I think sometimes gets lost in the policy battles is that, one, I serve on the RTP advisory group for the clearinghouse, and two, we really think it's a legitimate choice. If there are several of our bankers that are ready to do RTP or feel like they're large customers, and I do think businesses will drive this. I think it's going to be commerce that drives this more than P2P. In that, we have, if your municipality, if your hospital, if your town, county government, or your utilities want to send you money that way, you can't tell those customers that they can't receive it that way. And banks are going to have to look at that.
And that's exactly right. The business B2B side, or maybe B2P side, is again where I think a lot of this goes, because in the cash analogy, there are places where I might not want to send a real-time payment to Carrie if I don't know him, or if I'm purchasing something from him online. But there are lots of places where, again, if I want to make sure that my utility company knows and has verified that I've paid them, because I want to be able to keep my lights on or keep my cable on. Those things are going to kind of drive that adoption, we think, and drive interest in it. And again, at this point, outside of the policy discussion, the timeline seems to be what it is, and the market will drive a lot of this decision around whether more adopt. And then I think that's the other kind of question for the Fed as they move forward is, what market are they stepping into? If they could kind of, again, flip a light switch and be there today, the product might look a little different than where they come in 4 to 5 years. And lots of other kind of aspects of that, as well as like how they attract volume and other things.
Well, and that sort of choice of a payment provider only really makes sense if these networks are interoperable, which is where, which is a kind of big question, right? Like whether these networks can be made interoperable. I guess, Tom, what do we know about interoperability of a Fed-operated network and RTP right now?
So the Fed has come out saying that the day one FedWire will not be interoperable with any private system. I'm not aware, gentlemen, correct me if I'm wrong, I'm not aware of any government-sponsored real-time payments platform that is actually interoperable. Famously, the European version is not. And this lack of interoperability means fundamentally that it's not a real-time payments platform, because it's not instantaneous. So that, I think, is going to be a key issue when the Fed does introduce FedWire. And it's fun, just to draw that out a tiny bit more, to talk about having a choice between the private and the public offering. But realistically speaking, most banks will have to adopt both services because they have to be able to reach their customers wherever they are. And if the two different services can't communicate in real time with each other, there's no point.
Well, some banks would. I mean, if you look at wire transfer as an example, wire transfer does not have interoperability between FedWire and ChipsWire. However, wires get to folks. Some banks have joined both, but many banks have just gone with one solution or the other. Is that the most desirable outcome? I would agree with you that it's not. That shouldn't be the model that we go with. But the wires happened even though those services were not interoperable. It did not become a real-time payment or not become a wire transfer because of that. And I think that's going to be our crawl step into a crawl, walk, run.
So something that I've never really been able to understand is like, why can't these networks be interoperable? Like, I mean, we can put a man on the moon, the Washington Nationals can win the World Series.
Yes.
Anything can happen.
The Astros can take out a guy throwing a one-hitter. Yes.
So why? Like,
Sorry.
But I mean,
Yeah,
it's fresh
I
in our
agree.
minds. It's
I
important.
agree.
But why? Like, why can't that be done?
So again, good question. We've talked about this a lot, and I feel like and Carrie can answer as well, I feel like as I talk to folks, the public policy leaning folks say just that of, come on, we can do anything. Like I send an email from Google and it gets to Yahoo. I can do this, I can do this, and it's all kind of happens. The understanding I have is just that they're different platforms, and so there's a delay in terms of, you might be able to get it across, but to actually settle, you've got to reconcile because you're just on two systems. It's just as simple as that. You're on different systems, so it can't be, within seconds. That said, it's the position of, again, we're BPI, we're not TCH, but it's the position of TCH that they're going to try to make it interoperable. They're not looking to withhold volume. The benefit of their network, again, is its reach. And so if reach is done because you can achieve interoperability, then you've expanded the reach and the network is more valuable. The concern is more can you do it? And the example that he cited from the UK has been that it hasn't. What that looks like, again, I think is going to be somewhat down the line in terms of what are the costs of that not being interoperable. I think right now we can speculate and say, it might mean that some banks can't, make a real-time payment to other banks. It might be more like the example Carrie cited, but those are things that I think people need to consider and try to make. Again, people are trying to work towards interoperability. It's just maybe that it's not doable because you're on different platforms.
But is it like cold fusion, like it just isn't possible? Or is it like it's maybe possible, but it just hasn't been done?
I think if it were cold fusion, that would be people would be able to spot that. I think, again, people are going to try to work towards it, but it just may be something that they can't get to. It's...
Well, I mean, like, if a lot hinges on that question, right?
I think so.
If a Fed's network is going to be sort of like Betamax and VHS, then economically it doesn't really make sense to have two long term, right? Is that
correct? I mean, our position is that there should be one. There should be ways to address access and pricing that are outside of the Fed developing a secondary system. We think that's the best way to achieve reach and scope and get everybody kind of on the same system. We think it's just a complication to try to add a secondary system. But again, if they're moving forward, we need to figure out what those costs are, what things are lost. But obviously, it's one large network with everybody attached is kind of the cleanest, easiest solution to wrap your head around how a real-time payment functions. But there still may be banks who don't sign on to either. And so how that bank operates or receives a real-time payment is going to be another kind of third question that's out there in terms of interoperability. Again, the likely answer is that those customers will be disappointed and migrate. It's not a great long-term business plan, but it's a secondary kind of consideration in interoperability.
And it's those handful of banks on the other side that also kind of worries me. A term that we use a whole lot in the task force as we talk about ubiquity, and it was a word I never used before I started getting into payments. But ubiquity really means every single one of the banks. I think that everybody needs to participate for this to work. What we've seen, we could go through a lot of closed loop networks that have not been able to send money from any one bank to any other banked customer. ACH, one of our banks, decided to do a P2P app with another bank. And on day one on ACH, he was able to send money to any banked customer, even though they were two participating banks, because he was a member of a ubiquitous payments network. Everybody could get that money. That's the infrastructure I think everybody is striving towards with real-time payments. And that's why access is so important. That as soon as some banks don't play, then it becomes half of a network or a smaller part, and you don't have that reach that really is pretty cool with the ACH, that you can set something up ACH-based and send it to any banked customer. That's what I think we're all aiming for in real time.
But that's mandating that everyone join this network. And TCH would, of course, argue that everyone has access to their network if they choose to join it.
It doesn't necessarily have to happen through mandate. It's going to take a long time if it happens. The first step you have to have is have some sort of critical mass. And by that, I don't mean just mass of deposit accounts, but really a good portion of community banks, credit unions, coupled with those big volume banks. And that's the first step that we really have to look at before we talk about anything like mandates. And our work is cut out for us
Already,
just trying to get to that critical mass.
And to kind of the other side of the question, why it works now that you can have two different systems is that you have this time between clearing and settling to adjust for being on two different systems. And so, again, most of us are used to that happening in a lag. The way I kind of tell people outside of our space what real-time payments is, it's kind of what you think is happening with your money, and now it's actually going to happen. You send a payment, you think it's out of your account, and now it really will be. That works because of all this stuff behind the scenes. Mm-hmm. When you're moving to a system where you're telling people that it's really accessible right away, or again, if you're moving to these uses for small businesses or big businesses where it's going to be available right away, it kind of really has to be available right away and not bump into these things of, well, it is right now, except for like half their customers who are at this bank who didn't join. And so it's getting at that. The value is going to be in the reach.
But like, is there any value in having, like in terms of resiliency, is there any advantage in having two networks that aren't necessarily like so ubiquitous, right? So if there's some sort of a cyber attack or some sort of shortcoming with one network, you can still.
I think if you were going to say that the benefit to the Fed coming in is resiliency, then you're really walking down this road where everybody's got to be on both, right? Because if you're worried that one thing's going to be knocked out and so we'll just switch over to the other, that doesn't work if half are on one and half are on the other.
Kerry, is that true?
Well, I think it's unprecedented that we've ever had a blade on the Swiss Army knife of payments that has had a single provider. And it's new territory on each. I do think that in the case one knocked out, I do think even if we looked at something like Wire, there's adaptability, even though there's not a lot of, that infrastructure could be used to recreate the reach. So I would say that it's moving to unprecedented space to have a settlement monopoly on any payment rail.
but there's of course nothing preventing any other private firm from creating its own network.
No.
But then the other question though is like, you'll certainly want to address resiliency in the next 4 to 5 years, right? And I think there are ways that I'm sure the Fed is encouraging TCH to develop resiliency and to have kind of operational strength in the 4 or 5 years where this is the only thing up. And so I think you could probably build on. One of the things I think we view in several of these areas is that there might be other ways to get at concerns of resiliency. There might be able to get concerns of access and pricing and reach and who's on, who's off. Short of the Fed building another system, I think there are ways for the Fed to kind of use its supervisory capabilities, its regulatory capabilities to drive some of these things. There may be places where they don't feel like they do, and they could again look to Congress to see we're in a new place, right? This is a new system. How do we want to think about it going forward? Again, some of what was how we got here a little frustrating was that a lot of that seemed to happen certainly with the Fed, with working groups, with a lot of participants, but then as things move towards announcement to development, some of the congressional concerns around how that was all going to work seemed to just have been raised, but maybe not fully kind of vetted or paused on.
Well, Carrie, I was going to ask you also, to what extent is if you have these two networks and how they kind of interact, fast forward 5 years from now, and that's where we're living in, how much of that is like sort of governance, right? I mean, the ACH network is governed by NACHA. I don't know if that's how you phoneticize it, but, and there's a traffic cop, in the ACH network. Is that sort of just an operational thing that needs to be worked out, and to what extent can that help these fundamental issues?
Having worked in a previous life for NACHA, I will say this, that I wouldn't call them a traffic cop. I would call them a rules and standards development group. And they develop the rules and standards for, they maintain the rules and standards. And I'm going to put a little nuance there. I think to get to where we need to be in interoperability, I don't think using a total open group, and this is a personal opinion, you might read in a comment letter from me something totally opposite, because this is, my members may not totally agree with this, but from sitting on myriads of rules and standards groups, they're really good at maintenance. They are not good at creation. And it may take the clearinghouse and the Fed to go into a room, come up with draft 1.0, then pitch it to the industry, rather than rules and standards groups. Again, they're great at maintaining things, but sometimes that type of, dare I bash democracy, but that type of democracy just doesn't work when you're trying to stand something up quickly. It works really well on maintaining it and keeping that blade of the knife sharp, to just milk that metaphor for all it's worth.
I do like that we're taking positions that our members might not agree with and pushing on democracies.
Oh, yeah,
we can get very
I'm
interesting
just
now,
totally
now
out there. I'm going to be run off on the rail here.
But Mike, I mean, is governance something that is important, or is that something that?
Yeah, of course. Again, if in the way we would envision a system if we had our druthers, where it's TCH operating RTP and becoming ubiquitous, and every one of Carrie's members joining, those things would be critical. It's obviously critical infrastructure, right? You would have to make sure that, again, the people accessing it are, appropriately supervised for cyber and other things. I think we probably agree that this is not something you want to just plug in, the internet storefront to, or any of these other things. We want to make sure you're a regulated institution. You could impute some of those costs better and then kind of be on a more competitive footing. I think the idea is that if you are going to be in this space, if you are going to be one of the Swiss Army tools in the same space, you should try to make your costs look as similar as possible, because otherwise you're just a government player, and you can use your low-cost funds as a way to drive someone out of the market. That's not good for anybody. I don't think that's what anyone's arguing for, is that if the Fed comes in, they should underprice, subsidize and drive someone out. We think that the idea is to compete and not otherwise.
I mean, Carrie, how does...
We're probably at our break portion.
Oh, we are? Okay. Well, let's just take a break here, because we have our...
It is my privilege to introduce Congressman Ted Budd, who is in his second term representing the 13th Congressional District, North Carolina, and for purposes of today's discussion, a member of the House Financial Services Committee. Congressman.
Thank you all very much, and I've actually was recounting in the elevator that this is not the first time I've been here. Before I was even elected to that first term, we visited just down the hall in Doug's office, gave me lots of wisdom and pointers. So far, so good, right? Right. I appreciate that introduction and all you do here at the Forum for Free Markets and so much more. And I enjoyed seeing you, of course, on committee. Maybe a little less now, because since we don't have quite as much space as we did last year. But we'll see what happens next year. So, I was excited that Mike Lee was on the panel, and then I realized it's a different Mike Lee. We won't see the same artwork that used to describe the Green New Deal, and maybe we'll have to wait and see that at the National Gallery of Art. But this is Halloween. Happy Halloween, everybody. That's an old English word, if you will. It comes from hallowed evening, and that's 502 years ago on hallowed evening that Martin Luther took a 95 theses and hung them on the door of the church of Wittenberg in Germany. So 95 complaints, if you will. So I was thinking about that historically. I'm thinking, what complaints would we hang on which door here in Washington? But I only want to talk about one of those theses or one complaint today, and that's about the Fed's decision to get involved in real-time payments, what we know of as FedNow. I think it's very harmful, and especially to the consumer. But I want to update you on what I'm working on in this space and what I'm seeing from the House Financial Services Committee. First, what's bad about it? First, as you all know, that the movement to real-time consumers and businesses and to the economy as a whole. For example, real-time payments could save billions of dollars to American families, those especially that live paycheck to paycheck. And it could reduce their need to take out loans against their paychecks, and it also could reduce the frequency at which they experience overdrafts. So that's why I think that the proposal by the Federal Reserve to create a Fed-operated real-time payment system to compete with a private sector clearinghouse, I think it's ill-conceived, and that's for several reasons. Mainly, it's the fact that they will be competing with a functioning private sector role, and that's just not exactly the role of government. And I want you to remember that only 3 or 4 years ago that the Federal Reserve encouraged the private industry to operate a real-time payment system. And they did so. And now the Fed wants to displace that with FedNow. And I think that's just flat out wrong, that they would encourage something. Now, I never knew my paternal grandfather. He was born in 1890 and died in the 1950s. But he had a really simple saying. It's just do what you say you're going to do. Just do what you say you're going to do. And that's become somewhat of a family motto. Our family business that I grew up in, it's emblazoned on the wall there. And so I'd say to the Fed, just allow private industry to do what you told it to do. So additionally, in a clear conflict of interest, the Fed would be both a competitor of the clearinghouse, for RTP, and it would also be their regulator and also their supervisor. So not only is the Fed competing in the private sector, but the Fed payment system is exempt from antitrust scrutiny, unlike the private sector. And according to the DOJ, the private sector model not only created numerous benefits to the consumer, but it didn't raise any of those same antitrust concerns. So the Fed's proposal to compete with the clearinghouses network, now remember, this is the thing that they encouraged to even exist. It had already had a negative effect on RTP's ability to attract new network participants, kind of forced them into a wait-and-see mode. And I talked to community banks back home who, when they're faced with investment costs, they were already hesitant to look at the private sector option. But now that the Fed's made this decision, the delay's going to be even longer. So again, the consumer loses out. So let's talk for just a second about costs. Now, traditionally, the Fed could just buy the tech that they needed, but in this case, they're actually going to have to build FedNow. So these costs are going to include the cost of building the alternative payments infrastructure, which is likely hundreds of millions of dollars. We know that's going to detract from the Fed's remittances back to the Treasury, as well as it's going to cost the extra network connections to banks that either choose to join both networks or switch from the RTP system over to the Fed network. Now we say, I mentioned a second ago, hundreds of millions of dollars, but we really don't know. That's just an estimate about what that would cost, and there's been no estimates to this point even given to Congress. So what am I doing about it? If you look at Bill H.R. 3939, And that's my legislation that would delay implementation until we do a full quantitative impact study, or QIS. So it's a good step that I hope raises additional concerns with FedNow. So right now, the goal is just to keep the pressure on the Fed and to raise this issue publicly. And so finally, I just want to make this one point clear, that I'm tired of Democrats really pushing these reckless policies, like supporting the Fed's decision and then FedNow, and I think that harms the consumer. All the while, they tend to claim this moral high ground over Republicans. It actually, this system as is, I think it benefits single parents, these small business owners, those on the lower income spectrum, and I think we need to preserve the system as is and really raise some real concerns with this QIS. I appreciate all your time, and no matter which Mike Lee is on the panel, you're in good hands. All right, thank you. Right on.
Thank you very much.
And I want to thank the panel for their indulgence and patience, and hand it back to John.
All right, time in.
Game on.
Game on, right.
Go sports.
So we were talking about the economics of these networks. How self-sufficient does a Fed-operated system need to be? And maybe a converse way of asking that is, how inefficient would it have to be for them to decide that it's no longer makes sense to put up their own network? I guess I'll send that to you, Carrie.
Okay, that's a good question, but a tough question.
Yeah, sure.
I think from that, obviously, it goes back to the Monetary Control Act and those three tests that I provided right before the keynote speaker, and that is cost recovery. Can the market do it on its own? And then the last test is, you benefit to the entire industry. I think if any of those changed, the Fed would have to assess that and realize whether they're necessary or not. But from a decision standpoint, it's the Fed's got the authority to make the decision, and so they're proceeding. I don't see this as a politically reversible decision. I think this could be an economically reversible decision if the economics changed in the way that, let's say, the clearinghouse suddenly, 5 years in, is close to 11,000 institutions. Those are things to look at. But again, we have an example. If you look at the knife, there's not one entity participating in any one settlement rail. So that's something we have to look at. That's new territory for us.
Mike, how do you guys view this decision? Do you view this as something that the Fed could reverse? Is this something that that the clearinghouse could? I mean, as Congressman Budd mentioned, the Fed sort of encouraged this RTP to be created and then created a competitor to it. Is there any kind of legal recourse that might be available to TCH? Is there an administrative, kind of pushing regulators to kind of change their mind? Maybe we have a new Fed chairman in a couple of years. So what do you guys view this as? Are there avenues to kind of maybe get them to go back?
I think there are. I think politically it's challenging. I think, if a different makeup of the board, you might have a different vote, but the vote this time was 4-1, right?
Yep.
So you'd have to have kind of a significant change in the guard. Again, I think it's a great point about, and what I was, I think, trying to say as well is, where are we in 5 years and where are they trying to come in? Again, if they somehow along the way decided, well, we want to be the, like we have in broadband, we want to be the last mile to get to the institutions that haven't been reached, versus I think they view their role as a competitor, and so wherever we are in 5 years, they want to come in and compete. Again, I think it can be reversed. Again, I worked briefly at the Fed. There's some Fed folks here as well. The Fed often, and this is not meant to be sounds bashing, but if there's an issue, they look to find the way to address that issue, not revisit the previous decision that goes on in markets and things like that, in regulatory space. Again, that's not because of any trying to take over the world or anything like that, but it's we felt good about doing this thing where we felt like we need to be in this space to provide competition. If they get there and there's only 5 banks left, I don't think they're going to say, oh, I guess we didn't need to do competition. They'd say, well, there hasn't been any competition. That's why there's only 5 banks left, and here we are to compete. And a measure of our success competing will be how many do we get onto our system.
I thought we maybe want to take some time for questions, right?
Yes.
So if you guys have questions.
If you have a question, please wait for the mic. Stand, identify yourself, and ask your question in the form of a question, with a question mark at the end.
Hi, I'm Cam Fine. My first an observation and then your reaction. I've been in the business for about almost 40 years. I was a community banker in Missouri a year before I came out here to run a large trade association. And in my community bank on 9/11, which was a horrible day, I was informed by the large banks in St. Louis and Kansas City that they were paralyzed and they could not accept our cash letter. They couldn't process for us. We were dead in the water. And of course, everybody, all our customers were wanting their money. And they wanted currency. They wanted currency and coin. And the large banks that were our correspondent banks couldn't supply that because they were in chaos. And of course, New York was in chaos. And the only entity that could keep the payment system going was the Federal Reserve. Thank God to the community banks at that time. There were probably over 500 community banks in the state of Missouri. And the St. Louis Fed and the Kansas City Fed were the only entities that were able to push currency and coin to the banks, process our payments. They kept the system going, the blood flowing through the organism. And I worry when I hear this talk, like the congressman, with all due respect, that was just horse hockey. If we have another 9/11 event in this nation or something analogous to that, and there's only one payment system, and that's a private payment system, and those that run that private payment system are paralyzed by the event, what happens financially in this nation? Who steps in and keeps the money flowing? Because the first thing the citizens do, I experienced this live, is they want their money now. And there were runs on banks all over the state that day. And thank God the Fed was pushing couriers out from their own offices with sacks of money, basically. So my question is, what are the provisions if there's only one private sector payment system and there's no Federal Reserve, no central authority that's involved in the system? What happens when we have a cataclysmic event? Because it's naive to think that we'll never have another cataclysmic event. Thank you.
Go ahead, Mike.
No, thank you. I think it's to the Swiss Army knife analogy. We're not talking about taking away cash. I mean, they were pushing out cash, right? And I think the Fed issues currency, right? So they're the ones who are going to push out cash when there's need for cash.
Well, it wasn't just cash. They wouldn't
No, I know.
accept our wire transfers.
I know,
nothing.
but they're, again, I would say that they're, even if there's an RTP that is operated solely by TCH, the rest of the toolkit is not going away. There would still be ACH, so there would still be these other substitutes. Again, so I think if something would happen in the next 4 years, we would find substitutes just the way they did on 9/11.
Just kind of like tie that in with, we were talking about the economics a second ago. Like, to what extent is resiliency alone a justification for having a second network, even if it maybe doesn't, maybe it's like a little on the edge of being cost recoverable? Like, is it just smart to have a second one of those in operation in case of emergency? As you said, maybe a cyber attack, maybe a terrorist attack or whatever. Like, is that a justification?
Again, I think I kind of addressed it earlier that it would kind of mean operating or connecting twice on an ongoing basis. Again, FedWire and ACH, or sorry, FedWire and the TCH system today both have redundant systems. They have everything that's going on being, done on separate servers as well, so that if something were to happen to those servers, these other ones are up. There's nothing operating today that's just on the backs of one building full of servers. So again, those types of resiliency I think would be built in, or are built in. There are systems, again, that are designed to be difficult to find, difficult to attack, difficult to have someone drive up a truck in front of, or any of those kind of things. So that there is resiliency. It's absolutely something people should be thinking of and aware of, but I don't think that anyone should assume that there's just kind of, this is all on a floppy disk at TCH right now, and someone walks out with it.
But I think having two systems can benefit. To use an analogy, use an illustration that's not 9/11, but during Hurricane Sandy, there was a major core processor that one of their data centers was out for a while, and there was access. A lot of banks experienced problems accessing their customers' records, and that affected banks on a day-to-day basis. So resiliency is an extremely important concern. I also think, though, that having choice, having a multiple of options, is going to make both parties stronger and make both products better, because one, they compete, but two, they're going to have to work together. And hopefully we can create an ecosystem that'll reach out to everybody.
Do we have any more questions?
I don't need a microphone.
You do for what next? You're vast and doing public.
Hi, my name is Matt. Just a really quick question. You guys have kind of really touched upon the network effects necessary to make these systems work. What would you see as the minimal amount of adoption needed for a Fed system to be economically viable? And then if they are unable to reach that level of network effect, how do you envision it playing forward in a place where community banks have criticized TCH for potentially having anti-competitive either inclinations or potential?
How big does a Fed network need to be, Carrie?
I think that real-time payments, and I'm not saying Fed network, I am saying real-time payments needs to be in every single bank, and I would even extend that to financial. Any regulated financial institution needs to have access to that. Getting to a specific number, that's a tricky thing. I do think critical mass to start thinking about how do you get it ubiquitous, two things need to happen. One is interoperability that we've discussed. It's a desired outcome from the Fed. It's something that we've talked, that's got to get ubiquity. Both systems have to talk to each other, bottom line. The other measurement is reaching that critical mass of banks. And that's not just the deposit, the volume banks, but to me, I hate to play percentages, but you're really talking, trying to get 50% before you can start having the discussion, how do we get to the last mile? I think you have to get to the first 100 miles before you start talking about the last mile.
Any others?
Yeah, hi, Ed Hill. You guys talked a lot about the benefits of competition, and you talked about the benefits of interoperability. But aren't there real costs to interoperability, namely competition and innovation? How can you have two systems that are completely interoperable? If one of them wants to make an innovation, do they have to wait for the other to catch up in order to have that interoperability? So I wonder if you talk about some of the perhaps downside of interoperability of the two systems.
What do you think, Mike?
I think it's a great question. I think one of the things that, and I'll want to hear Carrie's thoughts as well. I'm sure all of you do as well. The when we talk about the benefit to real-time payments, I think everyone immediately jumps to speed, right? And what's better than speed? Once we have speed, we're arrived. But the broader benefits and the broader promise of real-time payments is not just that, but it's all the things that are going to go on top of it. So these are rails. What are the things that go on top of the rails? So where are you going to be able to, again, from your phone, pay instantly to your plumber, or when you pay your plumber, is he going to be able to do that by sending you a message that has a photo of his work being done, and so I'm at work, I can make that payment when I'm done. I think the question around whether those things, whether one moving faster in terms of adoption of new products or new services changes the interoperability equation, I think is worth noting. I think people, again, our general sense is that the Fed would move slower than TCH would in terms of adding new, kind of what they would view as customer responsiveness. The Fed has to kind of, again, by nature of being a government entity, they can't just say, oh, these guys have a real cool innovation, let's go slap it on. It seems like that process might be a little different for them than TCH. And again, whether that impacts the ability of that payment to go through, I think seems to be a reasonable question. But again, it seems like there's a lot on interoperability that needs to be.
Yeah, this is a tricky question as far as there's certainly, if we look at the ACH, there are a few things that you can do with TCH, particularly some identifiers that do not exist in the Fed, and it's worked out. It's worked out fairly well, even though there have been those key distinctions. I do think the Fed's process, as I'm getting, is to really engage with the banks that may or may not be their customers and find out what they're looking for. The cautionary tale is we can sit here in our crystal ball, like we did with Check 21, and sit there and tell, all the lists of use cases that I think this is going to happen for. And when Check 21 became law, 2 years afterwards, everybody was getting their checks via their cell phones. We didn't see that one coming. There is going to be use cases. The best use cases, I guarantee you, are not the ones we're talking about today.
Right. I think that's a good question as to whether, because part of the, again, by having this discussion of what do we build today, when TCH was building, it was, you mentioned credit push being a feature of it, but also data richness, right? And so with the idea that in the future you'd be able to send a payment that has the payment information, but also if you're a business, the invoice information.
Right.
Right? Messaging rich. So what does that mean when it bumps up against another system? Is the other system equally messaging rich? Do you want it to be? I think is another kind of policy question that we haven't really touched on. Do you want, again, if you decided you're comfortable with this information going through your bank channel to another bank channel, are you comfortable with that hitting some kind of Fed process and having the Fed be someone involved in that data being transferred back and forth, what you're paying for and details of it? Are things that I think are also worth discussion as they look to design a product. But it is a good question, like how, it's not just the dollar amount that's going and who it's going to and a routing number, right? It's now, we can do a lot more than that. That's part of the promise to business is that, we can kind of, businesses spend a lot of time taking the check and the invoice and having someone run back and make sure that this check goes with this invoice and not some other invoice and that those things are current. And being able to have those in one message and having them kind of occur instantaneously is part of the big promise. And if that were to be a casualty of interoperability, I think that would be a big deal. And that would be something people would want to know as they move forward. At least I think in terms of people we've talked to, we talk about the promise of it in terms of lowering costs and reaching more consumers.
Well, I think the mere fact that the Fed has to initially stand up a minimally viable service means there are going to be a lot of bells and whistles that will not be on there. To get a service that is interoperable, you have to have a service. Right. I mean, I often, when I talk about choice, here's the choice right now. The choice right now is you've got a company that has a product, it's minimally viable and progressing, and it has not demonstrated reach to community banks. On the other side, you have an organization that has all the reach in the world and doesn't have a product. So there's room to work on both sides. You know, TCH is going to be looking at the community bank market, which is a new market for them. On the other side, though, the Fed has now got to, and this I heard in Chicago last week ad nauseum at a Fed symposium, but to quote Wayne Gretzky, they've got to skate to where the puck's going to be rather than where the puck is.
That's it. Any more questions? Looks like not. We good?
Please join me in thanking the panel.